It's the government's shocking admission. I'll show you why. Hell is coming. Now, I've been warning for a while that the labor market was going to unwind, but I'm not the only one, as Feds Waller and Bowman both cited labor market worries for the dissent. And this was quickly dismissed because everybody knows that President Donald Trump said the next Fed chief is one who is going to cut rates. The market said, look, they're just pandering here because the Fed needed to keep rates steady and needed to deal with inflation because the labor market is strong and robust. But then we got today's non-farm pay report, and it turned everything upside down. Let's take a look at what Waller had to say. He said, I believe that the wait and see approach is overly cautious, and that in my opinion does not properly balance the risk to the outlook and could lead to policy falling behind the curve. And yet the issue was that the non-farm pay report was in opposition of everything we were seeing across the economy. Even the ADP report from the month before printed a negative number. We've seen a lot of the regional Fed manufacturing surveys, the ISM surveys, even S&P Global saying that employment growth was slowing, even going negative in some cases, but yet it wasn't showing up in the headline report. But again, Bowman confirmed this. She said, the labor market has become less dynamic and shows increasing signs of fragility. And sure enough, today we found out it was far worse than everyone thought because we got massive revisions to the non-farm pay report. We'll talk about in the moment here because let's turn to what President Donald Trump had to say. He said earlier on Friday in a separate post, he urged other members of the Fed's Board of Governors to, quote, assume control if Powell continues to favor holding rates. But there is a good chance come September, we're likely to see a rate cut. It may only be 0.25%, but the odds are building it'll be a 50 basis point cut. Now keep in mind the Fed only meets about every 6 weeks, and the biggest barometer is to your treasury yields. So we'll be watching that over the next several weeks to see what the bond market tells the Fed. But if yields continue to tumble, watch out. The Fed's going to be cutting in a big way. But something that should be surging higher as well as your trading account, because we got in on the bond trade before it took off today. Let me take you back to the 30th. This was a trade that went on to both our CTA Timer and our Momentum Timer Pro subscribers. We told them to buy zeros at zero coupon 30s at the open. As of yesterday, the trade was only up 0.23%. As of today, it's up a whole lot more. And this is coming right out of our newest meta strategy that we're giving away to any of our subscribers at absolutely no additional charge. Stay tuned to the end of the show to find out more about it. Grab the links in the description below. Use the coupon codes for your free 30-day trial so you can get in on these trades as well. But let's turn to the payroll report, because what we found out is it dramatically slowed over the past 3 months. And again, the Bureau of Labor Statistics told us before that we were seeing these outsized prints, over 100,000 jobs created, when again, every other labor market statistics was telling us just the opposite. And granted, initial employment claims were rather low, but continued claims continued to move higher. And again, that's a major issue here because nothing made sense when it came to the non-farm pay report. Well, that is until today. And payrolls increased 73,000 in July after the prior 2 months were revised down by nearly 260,000. So when we talk about hell is coming here, it's all about the economy. Because what are the two main issues that consumers are facing? Rising prices and a weakening labor market. My friends, it's called stagflation. Remember, we've been talking about this. Now the evidence is clear. It is indeed coming. In the last 3 months, employment growth has averaged a paltry 35,000, the worst since the pandemic. The jobless rate ticked up for all the wrong reasons to 4.2% last month. That number should be a whole lot higher, should be upwards of around 5% right now, particularly if you start accounting for the people who are not counting the statistics, people who have walked away from the labor market because there's no opportunity. But again, we talk about stagflation is building here. It's a weakening labor market. Now, I want you to think back over the last couple months, the stock market rallied on the hopes that the non-farm pay report was right. You want to know why it's plunging? Well, all of a sudden, the market's starting to realize that what the government was publishing was so far off. And that is really staggering here because we know the report gets revised. It can go up or down. But these large revisions are highly unusual, suggesting that indeed hell is coming. And the data sent a stronger signal that the labor market is weakening more notably, which is exactly what we've been warning about on this show. Not only is job growth cooling markedly and unemployment is rising, it's harder for unemployed Americans to get a job, and wage gains have largely stalled. Now, we've been talking about wage growth. Why is it slowing down? Because employers don't have to give out pay growth to keep their employees because they already know what their employees know. If you lose your job, the odds of you getting another one are really, really low. So I don't have to incentivize you to stay. Yes, do people get raises during recessions? Absolutely, but not as big as they used to. And that poses further risk to a slowdown in consumer and business spending that's already underway. Because when we look at the economy, what is the other issue consumers are facing? Rising prices and shrinking paychecks relative to inflation. And we've warned that this is exactly how it plays out. At first, nothing really changes. People didn't put money on their credit cards, they keep spending. But as the economy continues to slow, you start to see discretionary spending fall. And what did we see in the delinquency data? Wealthy Americans, they're falling behind their credit cards and their auto loan payments. It's a sign of economic stress. It's a sign the economy is going in the wrong direction. And the evidence is clear. Let's turn to this chart. This is average hourly earnings and average weekly hours of production and non-supervisory employees. Let's zoom in, because what do we see? As weekly hours, shown in red, go on the decline, you'll note that employees still get pay raises, and there's a simple reason why. As hours get cut, employers still want to hold on to their best talent, so they do give out pay raises. There's one big problem that happens here. As hours continue to decline, next thing you know, pay growth goes right along with it. We see that happen again going into the global financial crisis. You can see there's a decline in weekly hours, and then next thing you know, pay growth starts to head to the downside. And how about where we're at now? We can see very clearly going back to late 2021 that average weekly hours were on the downslope. Then they plateaued here. Now remember, we've been sitting at some of the lowest levels since the pandemic. Again, we talk about why people don't have money to spend in the real economy. They're not getting the hours. And all of a sudden, that means average hourly earnings continue to go to the downside, despite what you hear from experts like at ADP, who said yesterday, well, we heard from them. She said, look, we see that the labor market's fine because employers are still giving out raises, but it's not really a raise if at the same time you get your hours cut. And that's the issue that workers are facing right now. The economy is not working for them at all. And then, of course, the risk is if you lose your job, well, it's going to be very difficult to find one. In July, the number of long-term unemployed, that's anyone who's been jobless for 27 weeks or more, increased 179,000 to 1.8 million. The long-term unemployed accounted for a massive 24.9% of all unemployed people. And the other factor here is the longer people are on unemployment, their spending continues to decline because hope goes right along with that. And at some point, if they don't feel they're going to be back in the workforce, they slash their spending in a major way. And of course, as we know, that backfeeds all across the economy, right up the supply chain to the manufacturing level. And the sluggish payroll growth reflected declines in manufacturing, professional and business services, as well as government. Downward revisions to local government education payrolls contributed to the overall revisions in the prior 2 months. Private payrolls rebounded after barely rising in June, in a large part due to healthcare and social assistance. And so the issues, again, as we look up the supply chain, as demand goes down from spending, what happens? You start to see inventories build, and the next thing you know, new orders collapse, backlogs go away, and manufacturers have absolutely no choice to lay off. And that's exactly what we're starting to see here. Let's take a look at this next chart of manufacturers' new orders of durable goods in blue against the unemployment rate. Let's zoom into the dot-com bubble, and what do we see? Manufacturers' orders of durable goods, they go down, and then they cross that horizontal black line, leading to a contraction, and that means there's also a contraction in demand for workers. You see the unemployment rate move to the upside. Let's move forward to the global financial crisis. We see the same thing happen again. And how about where we're at now? Well, this big surge in new orders did not lead to a surge in hiring. This was a major red flag for the economy because it should have led to hiring. In the past, it usually does. But the fact is, all the manufacturers knew everybody was front running the tariffs, and that once that was over, new orders were going to collapse. And right alongside that would be the demand for employees. So they gave out more hours knowing that they were going to cut. The problem is now what we're seeing is the unemployment rate likely to start moving higher. And this is going to put massive pressure on the Fed, who's been saying, look, we need to contain inflation. And we've made the case over and over. If you're containing inflation, you're pushing demand down. You push demand down enough, what happens is you break the labor market. That's exactly what we're seeing in the non-farm payroll report today, and it's a huge risk because at some point the economy has moved to the downside to a level where nothing can turn it around. Now, you think back the other day, we did a show where we talked about how the fact President Donald Trump wants to see some of this tariff money go back into consumers' hands. It's starting to get obvious. They know all the way at the top that the economy is going the wrong direction, and so far, nothing's turning it around. The participation rate, the share of population is working or looking for work, dropped to 62.2%, the lowest in nearly 3 years. The rate of those between the ages of 25 and 54, known as prime age workers, also declined. And part of the problem here is that there is no work. So people are losing their job, they're going on long-term unemployment, and they're not even bothering to look because they already know there's no jobs. You know, think about this. If you work in auto manufacturing and you already know that they're laying other people off and that's your line of work, well, there's no point in looking because you already know there's no jobs. The issue here in the participation rate is those people don't get counted. If they did, the unemployment rate, it's north of 5%. And here we can see very clearly going into past recessions as we look at the chart of labor force participation in blue against the unemployment rate in red. You can see declines in the labor force participation rate tend to lead to a rise in unemployment when you go into a recession. And so that's the issue here is we're now likely to see the unemployment rate tick higher, and we have validation from that as we turn to the ISM. As we look to the manufacturing sector, again, remember all of this starts at the bottom and then moves quickly right up to the top and then flows back down. So consumers stop spending, new orders dry up, manufacturers have to cut workers, and as their spending from the manufacturing level dries up across the economy, it feeds all the way down the supply chain. As U.S. manufacturing contracts now at the fastest pace in 9 months. Now, the headline number only dropped to 48 according to the ISM, and in big world here, that only means a slight contraction in manufacturing. So nothing on the headline that gives you any red flags. That is until you look at the employment. A measure of factory employment slid to the lowest level in more than 5 years, suggesting producers are stepping up efforts to control cost amid higher tariffs and softer demand. And this is exactly what I've been saying was going to happen. As companies get squeezed at the margin and demand goes down, they're going to be forced to lay people off. And that's exactly what's happening here. But there's a whole nother aspect. It has everything to do with inventories because remember, everybody was front running all of the tariffs. They wanted to build as much of the stuff they could at yesterday's prices so they could push it through at higher prices and fatten their margins. What they're finding out is every time they raise prices, demand plunges. Again, we talked about what's going on at Starbucks and Chipotle and other fast casual and fast food restaurants. Traffic is going down. Let's take a look at this chart of advanced retail sales adjusted for inflation, or what's called real retail sales in blue, against retailer inventories in red. Let's zoom in and take a quick look here, because what do we see going in the dot-com bubble? That inventory growth rate was outpacing sales, and that's a big red flag. Happened again going in the global financial crisis, and look at where we're at now. Retail sales plunged right around 2022 and have remained largely flat. But look at retailer inventories. The growth rate far exceeding that. So again, way too much inventory in the system here and not enough demand to absorb it. You start to understand why the factory level is going to have mass layoffs. And government data this morning showed factory employment declined in July for a third straight month, the longest stretch now in 2 years. And average growth of total payrolls over the past 3 months was the smallest since the pandemic, according to the non-farm payroll report. So again, nothing good about the labor market. You know, the Fed is worried about inflation, but if demand goes down enough, you got to understand things get stuck on shelves of stores, and it can't stay there indefinitely, or the business will fail. They're going to be eventually forced to cut prices, move that inventory out. It's all about survival going forward, and when you're in that mode, employees gotta go. The employment index dropped further into contraction as panelists indicated that managing headcount is still the norm at their companies as opposed to hiring. But why would you hire if you got no demand? That's the issue here, is we see new orders drop. We're seeing backlogs drop. We're seeing demand drop. There's no reason to hire, and that's the problem because the economy is not working. That's what you heard back from Waller and Bowman. They're saying, look, we saw issues in the labor market. Fed Chair Powell didn't say he saw them, but watch, by September, he's likely to change his tune. Of course, in the minutes that will come out following the meeting, we'll likely see that they changed it in the minute notes that they wanted to cut. They just didn't. And according to Susan Spence of the ISM Manufacturing Business Survey Committee, the mixed indicators and outputs suggest companies are still being cautious in their hiring, even with an increase in production. But that's what we pointed out before. They increased production because they knew it was transitory. They knew this rate of demand wasn't going to continue, and they didn't want to hire people on and then turn around and fire them. So it's simple. You just give people more hours, and when demand drops, you can cut their hours back very easily. And the evidence is clear because in the ISM report, it showed a 6th straight month of contraction in new orders. Softer demand allowed delivery times to improve in July. And all that means very simply is when you order something and they tell you it's going to be delivered in 5 days and maybe you get it in 3, it's because the shipping companies aren't as busy. Look for them to lay off at some point too. A gauge of supplier deliveries fell below 50 for the first time since November as the index dropped nearly 5 points, the most since October of 2022. But here's a big one. Remember, when I said this goes away, so does the demand for labor. Order backlogs and export demand also remained in contraction. So what we're seeing here is new orders go down and backlogs are going away, and that means the demand for employees right alongside with it. Everything right now is playing out the way I said it was likely to based on the data. And again, this isn't something I want to see. I just want you to be aware so you can prepare. This is what's happening in the real economy, and based on everything we know, nothing is going to change the trajectory. Meanwhile, the report indicated manufacturers finding some modest relief from higher material costs as a measure of prices paid for inputs fell nearly 5 points, the most since September, to 64.8. So when we started the show, I said, look, hell is coming, and for good reason. You can see it. It's called stagflation. You see price pressure continuing to rise. What is going to happen at the manufacturing level? They're going to have to push some of these prices onto consumers. They're going to have no choice because they're now laying off, meaning they're already in desperation mode. Problem for consumers, they're losing their job and facing higher prices. We know what that means. It means stagflation is coming, hell is coming, and that means a recession down the road in the not too distant future. But something that could turn your trading account to the upside in a major way is our new Metre strategy. Now, this is something we've been developing. It's available to all subscribers no matter which program you sign up for, and we're making some big advancements in this. Let me show you what it is. The Metre strategy is an advanced trading system that combines 9 professional trading strategies into a single intelligent signal generator. It provides 31 more frequent buy signals than individual strategies while maintaining high quality through multi-strategy consensus. It pulls data from Bravo 9, Turtle Trading, a 200-day moving cross, a golden cross strategy, trend pullback. It also uses RSI divergence and a 520 EMA cross strategy. It also takes into account channel trading and Fibonacci retracement. It's designed for a target hold period of 2 to 15 days with an average of 8. It generates around 155 signals per year and has a success rate above 50%. That's right, 55% with fast profit taking. This is the next generation of swing trading, my friends, and we're going to make some even bigger advancements. All those strategies on their own, they're not as great as you might think, not as great as some people will tell you, but we're going to be optimizing all of them and then coming out with an optimized Metre strategy. And right now, again, you can jump in on this at no additional charge. Grab the links in the description below. Use the coupon code for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.